Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Friday, 10th October. Coming up on the show, will any side crack as the government shutdown continues? China ramps up its crackdown on chip imports with Nvidia clearly in focus. And what's the spookiest thing about Halloween? The price of chocolate. So grab your coffee and let's own the morning. Okay, we kick off with some breaking news. According to China's state media, Beijing is probing Qualcomm for alleged anti-monopoly violations. And Qualcomm stock is down on the news this morning, more than 2% right now. It's the latest sign that China is stepping up its crackdown on strategic American tech companies. More on that in just a moment. Well, the first thing you need to know is that the shutdown continues to rumble on with very little sign of the impasse being broken. Yesterday, a sixth vote failed to win approval. The thorny issue of reviving expiring Affordable Care Act subsidies hasn't gone away, and it's estimated that around 750,000 federal employees are now furloughed. If the shutdown is not resolved soon, then American troops will miss out on paychecks next week too. And after the absence of last Friday's jobs report due to the shutdown, next week two key inflation reports look likely to be delayed as well. The next thing you need to know is that China is ramping up its crackdown on Nvidia AI chips. Beijing has stepped up the enforcement of its controls in chip imports as it looks to stop its big tech firms from buying from Nvidia. Teams of custom officers have been mobilized at major ports. They're looking for Nvidia's H20 and RTX Pro 6000D processors. Remember, they were designed to comply with US export controls and still keep Nvidia's market share in China intact. And the last thing you need to know is how the peace deal in the Middle East has impacted on oil and gold. Oil prices are lower today. Yesterday, they fell around 1.6% as the market's risk premium faded after Israel and Hamas agreed to the first phase of a plan to end the war in Gaza. Under the deal, which Israel's government ratified earlier today, fighting will cease, Israel will partially withdraw from Gaza, and Hamas will free all remaining hostages it captured in the October 7th attack in exchange for hundreds of prisoners held by Israel. Gold prices slipped for a while yesterday, but are now back above the $4,000 mark. President Trump, who missed out on the Nobel Peace Prize to Maria Corina Machado, the Venezuelan activist, said he will travel to Egypt for an official signing of the ceasefire deal. Well, with what else you need to watch today, here's Josh Lipton.
Time now, what to watch Friday, October 10th. Starting off with the Federal Reserve, we're going to be getting some more Fed commentary on Friday, this time from Chicago Fed President Austin Goolsbee. Investors will be listening closely for any clues on whether recent data, or the lack of it amid the government shutdown, could alter the timing of rate cuts. It's coming after comments from Fed Governor Michael Barr on Thursday, Barr calling for a cautious approach toward further interest rate cuts, emphasizing the possibility that tariffs could create persistent inflation. Moving over to the consumer, we're going to be getting fresh data on Friday with the preliminary consumer sentiment reading for October. Economists forecasting sentiment to drop compared to September to 54, suggesting Americans are feeling a bit less confident about their finances as inflation and job market worries linger. And taking a little look at the nation's capital, we're in the second week of the government shutdown. Hundreds of thousands of federal workers are being furloughed, and key economic reports are being delayed. We're also seeing increased delays at airports across the country. The longer the shutdown drags on, the harder it becomes for policymakers and markets to gauge what's really happening in the economy.
The dollar has had some week. Just look at this chart. It's up against a basket of its major peers, as you can see. In fact, it's hovering near a 2-month high. But before its recent rally, it's been a tough year for the greenback, which has been in decline since the turn of the year. So is it making a comeback? Well, to help us answer that and more, I'm joined by Francesco Pasoli, FX strategist at ING. Francesco, thanks so much for joining us. Well, let's start with that thought. Is the dollar making a comeback?
We don't think it is. So we need to put this into context. The start of the dollar rally at the beginning of this week did not come from the US. The situation in the US does not currently justify a dollar rally because we have a US shutdown of the government. There are downside risks to the economy. And the latest data that we saw before the shutdown were not good by the ADP. But we had events in Japan and France that put pressure on the euro and the yen. They have a big weight on dollar indexes. And then that morphed into sort of like a broader dollar rally. Now, the issue we have with this dollar rally at the moment is that if it goes further from here, it would really not be justified by rates fundamentals unless we see a hawkish repricing in the Fed curve. And until we see data on inflation and jobs numbers, we don't think markets will feel confident to price out rate cuts by the Fed.
So are you saying that the factors which have seen the greenback falter this year, they're still in play then, basically?
Yeah, partly yes, in the sense that the direction travel to us when we look at 3 months, 6 months ahead, we still think is on the downside for the dollar. One of the reasons is indeed the main reason, and that is Fed rate cuts. When the Fed cuts rates, it becomes cheaper to hedge the dollar, and we saw hedging flows having a big impact on weighing on the dollar earlier this year. However, what we must acknowledge at the same time is that the bar for a sort of to re-enter dollar shorts has now risen because markets have become more tolerant on headlines coming from the US, from tariffs to Fed independence risk to consumer sentiment risks. So obviously it won't be, in our view, any replication of what we saw in the first half of the year, that uncontrolled dollar sell-off. But when we look beyond the short term, we still think that the dollar should be trading lower.
So let's focus a bit on the Fed here. I mean, it sounds that you think that the dollar could weaken further because we all, markets are pricing in more Fed cuts for the rest of this year. So, I mean, how much further damage could the dollar take here?
So our call for euro dollar by the end of the year is 120. Now, as I mentioned, when we look at the next two cuts, the ones that are expected to come in the next couple of months before the end of the year, we think the main impact on the dollar, given, as you mentioned, that it's almost fully priced in by the market, will come mostly through the fact that it will be cheaper to sell the dollar for hedging purposes. But then looking ahead, we still think that for the first quarter of 2026, markets are a bit conservative with pricing. And they're still failing to fully price in another cut in March. And we think that means that there is still quite a lot of room for dovish repricing. We don't exclude that there will be 2 more cuts already in the first quarter of 2026. So with that in mind, we could see, like, towards the end of the year, a bit of dovish repricing hurting the dollar in a period where generally the dollar is seasonally weak, and that's December.
Francesco Pesoli from ING, many thanks for your thoughts. Okay, it's time now for a short break, but when we're back, we'll take a closer look at the upcoming earnings season. Welcome back to Market Sunrise. We're coming up to another earnings season, and so it's time for a reminder on the key terms and processes you need to know to understand everything with confidence. Well, Jared Blickry has more.
Earnings season is right around the corner. It's a game played by Wall Street with head fakes, head scratchers, and insider jargon. And on today's Stocks in Translation, we're going to pull back the curtains and show how the pros play the expectations game and actually trade the print. So let's start with some earnings basics. Revenue is the top of the funnel. It's how much money goes in the door, and it's also called sales. Net income is what's left over after all the bills are paid. You can also call it earnings or profits, and if it's negative, that's a loss. Earnings per share, or EPS, just slices the pie of profits into a per share amount. And then there's GAAP, or Generally Accepted Accounting Principles. It's the official rule book, and it's required by law. But companies often decide to keep a separate set of books, adjusting for one-offs. That's called non-GAAP or adjusted. More on that later. Finally, free cash flow is king. It pays dividends, funds buybacks, keeps the lights on. Now, let's clear up some misconceptions that might be common. A beat means that the company exceeded analyst expectation, but that's not always bullish. Companies aren't required to issue future guidance, but if they do, it usually matters more than history. A GAAP loss reporting according to official SEC rules might sound bad, but if cash flows are getting better, the future might be getting brighter. And remember that non-GAAP or adjusted EPS can exclude things like stock compensation and one-offs. Always read the fine print, as many games can be played here. Finally, many companies have a fiscal year that's different from the calendar year. You'll soon hear some Q1, Q2, and Q4 results in October and November. Now, let's tackle some bullish and bearish signals that the pros are going to be watching out for. Bullish first. Like if a company beats on revenue and EPS with healthy margins, that means it's not just cost cutting. If it also guides future results above street expectation, that's a home run. But sometimes all investors want to hear is a confident tone. Nuance matters. And bulls also want positive and ideally increasing cash flows. Stock buyback announcements, they tend to broadcast strength. And the same principle applies for dividends, which are basically cash payments to shareholders. Also, are orders and backlogs turning up? That means demand is strong. Then we have the bearish side. A miss on sales or EPS plus a cut to future guidance as pretty negative, unless the street was expecting much worse. Then you have shrinking or compressing margins, which means the company isn't able to squeeze as much profit out. And if it's worse than its peers or competition, that's a big red flag. And we already talked about the games that companies play with non-GAAP or adjusted numbers. Is there a never-ending series of one-offs each quarter, or is management always blaming the weather, or a strong dollar, or the weak dollar? That's a pattern, not an excuse. And softening cash flow or inventories creeping higher, that's a canary. Now, here's how to trade the print, where the secret is discipline over market chasing. Remember that after-hours trading can be very thin. What does the market, where does it open on day one, and then how does it close relative to that open? If a market jumps higher on the open than that sells off all day, that can be a bearish tell. Then always know your time frame. Is it hours, days, months, years? Always address the dominant trend on your time frame. And remember, an uptrend is a higher high and higher low series, the classic stair step. When the step patterns change, your trend has changed. And finally, keep in mind that the big players with strong hands are not nimble and they have to play the long game, but they can cause short-term whipsaws to fake you out. Watch for breaks to the upside or the downside that are quickly reversed. Bottom line, when earnings season comes, do not chase the headlines. Keep a level head and be prepared, and always have a plan. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Okay, it's time for another break now, but stick around on Market Sunrise to get the latest on today's trending stocks and to hear a particularly tasty call in chocolate. It's time now for today's trending tickers. We start with Levi Strauss. The denim maker raised its full-year outlook on stronger than expected third quarter sales, and yet the stock is falling in after-hours trading as investors worried about margin pressure and potential tariff costs, down over 6% as you can see in the pre-market. Now, some analysts still see potential, but investors aren't convinced this morning. Next up, here's a ticker that's being propped up by a surprise move from Washington. The bank BBVA Argentina is continuing to rise after closing 16.95% up last night. That's because the US Treasury confirmed a $20 billion program to buy Argentinian pesos, effectively a currency swap designed to stabilize Argentina's battered currency and its struggling economy under President Javier Milei. Analysts say the program buys time, but only structural reforms can really turn things around. Now let's move on to artificial intelligence and quantum computers. Rigetti is surging again as speculative AI names stage a rebound. We are not seeing fresh corporate news, but the stock is now up more than 80% this quarter, fueled by bets that quantum players could be next to benefit from AI infrastructure spending. Analysts are cautious though. The company is still burning cash. Shares of Applied Digital jumped 20% in after-hours trading on Friday after the data center operator reported stronger than expected first quarter revenues, bolstered by soaring demand for high-performance computing. The stock was the most traded ticker on Yahoo Finance on Friday morning as the company rides growing momentum for long-term contracts. In Asia, two giants making waves. Samsung continues to rise after a very successful push into chips and AI infrastructure. For context, Samsung is up more than 30% just this month, over 6% up today. Finally, here's a tech stock that shows how investors are starting to fear an artificial intelligence bubble. Japan's SoftBank. SoftBank is in the red today after it announced a new $5.4 billion deal to buy ABB's robotics unit. As you can see, down over 3%. In this deal, like in many others, investors are starting to worry about highly leveraged debt and commitments based on the current sky-high valuations. Well, Jay Goldberg from Seaport Research Partners explained here on Yahoo Finance what are the cracks we need to watch out for in the current AI trade.
I think we're in a bubble, but we're in early stages of the bubble, and you can still make a lot of money. Stocks can still go up a lot from here. But I think people just need to be aware that we're starting to get a little bit beyond the realms of rationality and into more sort of faith-based, belief-based investing.
Well, when you talk about those 6 companies that are so pivotal to this AI trade, of course, there's been a lot of concern that everything is riding on just a few players. And even among those players, I mean, OpenAI is unique, as you point out, in that it doesn't really have cash flow. The others do have good cash positions. But the other, I mean, you know, we have the 6 up here, but maybe OpenAI should be in the middle of it rather than just one of the others, right? Because doesn't it seem like it's sort of the center of the web in some ways?
So I think that's the important thing that's taking place right now. In the last few weeks, we've seen 2, I think, big changes in what's sort of the pacing of things. The first is Oracle is now taking on debt to fuel its growth. And if you look at sort of historical bubbles, once you enter the companies taking on debt phase, that accelerates things. Debt is great on the way up. It juices things, but it's an amplifier. So it's good on the way up, and it makes things extra painful on the way down. The other big shift is that OpenAI has been, like you said, in the middle of lots of deal making, and it's an interesting company. It doesn't make a profit. It doesn't have free cash flow. It actually has pretty serious negative free cash flow, and they are the most aggressive out there signing deals. Just in the last 2 weeks, they've talked about adding 16 gigawatts of capacity, which is just a staggering amount of compute. And there are a lot of legitimate questions about where they're going to get that money from and what it's going to take. But critically, I think all the other names on that list are watching what OpenAI is doing and are afraid of missing out. They don't want to lose to this startup, and so they're going to spend aggressively to keep up with that. And that's why I think this bubble will keep growing.
And as it keeps growing, I mean, in the past, when we've had bubbles, there's always sort of a precipitating event, even if it's a small one that causes the house of cards to come down, to mix my metaphors. How could that possibly play out this time? What should investors be watching for?
So I think there's a lot of ways that it could fall. In particular, once you start adding debt, then you have timing becomes really important. And I don't think this is, I don't think any of the companies on the list other than OpenAI have problems with credit or making their debt payments. But there are lots of other entities sort of below them, right? You go first to the neoclouds, companies like CoreWeave and Nebius and Crusoe and Lambda. They're all taking on a fair amount of debt to finance this. And then beneath them, there's another layer of special purpose vehicles and smaller funds, smaller companies that are building all this. And it's not quite a house of cards, but we are dealing with smaller entities that don't have strong balance sheets, that don't have strong cash flow. And things, it's easy to see them getting tripped up and causing wider spreading problems.
The spookiest thing about Halloween this year might be chocolate prices. Consumer brands like Hershey, Lindt and Nestle have all raised prices, some in double digits recently. And that's because cocoa's price has more than doubled since early 2024. That's according to Wells Fargo. And even if it's pulled back from its peak, those higher wholesale prices are set to continue to push up the cost for consumers. So what's driving the price increases? Well, number one, less cocoa in the market. About 2/3 of the world's cocoa comes from West Africa. And a mix of extreme weather, drought, and crop diseases has hammered production there, contributing to a 12.9% yearly drop in global cocoa output. Number two, US tariffs. Key producers like the Ivory Coast, Ghana, or Ecuador are all facing new tariffs of up to 25%. That means importers must pay more just to bring the raw materials in. Number three, demand has been on the rise, and some analysts say the market will keep expanding at around 5% a year. Basically, chocolate makers know that we are going to keep buying, even at a higher price. So, what can you do as a consumer? Well, you can find products with a lower percentage of cocoa. You can also look at cheaper options like generic or store brands. Also, always look at the price per gram, not per bar. Many producers are reducing the size of their packaged products while keeping the same price tag. Well, happy trick-or-treating, and may your Halloween be sweet. Okay, before we go, let's check in on the markets. Let's start with Bitcoin. Now, it continues to slide. Remember, earlier this week, it was trading above $126,000. Now, at about $121,500. Okay, let's move on to gold. And as you can still see, it remains above the $4,000 mark there. There was a slight dip on Thursday for a while, but it soon recovered. Okay, let's move on to Asian markets now. And the bulls in the region certainly look like they took a bit of a breather there. You can see there's more political uncertainty in Japan, with the coalition government looking particularly fragile right now. And that sent the Nikkei lower, down by over 1%. The yen's recent slide, though, was halted because of that political uncertainty. All right, let's turn over to the European markets now. And they are mainly lower, but not perhaps as badly as they were in Asia. France's President Emmanuel Macron is expected to name his 6th Prime Minister in under 2 years later today. European stocks in general, though, are heading for their worst week since July, and that's mainly because of the uncertainty we're seeing in France and what they could do to try and resolve their budget problems there. But as you can see, down about 0.1% today. Okay, finally, how will Wall Street open? Well, US stock futures seem to be sort of treading water this morning. They are up slightly, but this is after, record highs as, data-starved investors wait for a reprieve from the government shutdown and for earnings season to provide inspiration. Remember, next week we'll be hearing from the likes of JP Morgan, Goldman Sachs and Citi. Wells Fargo too, so lots of banks to look out for next week. Okay, and that is all we have time for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.